Welcome back to All Things Money. I'm David Blain, and during today's show, we're taking a look, first of all, at the housing market, and is there light at the end of the tunnel? As always, we'll give out our phone number here is 252-633-0107. Our email is allthingsmoney@dlblain.com, and our web address is www.dlblain.com. There you can find information on myself, as well as my firm, and listen to some archive copies of the show. We were talking before the break about the housing market, the excess supply and demand. What I want to focus on this segment is how long typically do housing downturns last? That's everyone's big question, is how long is this going to last? Well, let's start with a few statistics. First of all, the current downturn has lasted a record 60 months. Sales have fallen by 52%. Now, believe it or not, that's not quite a record yet. In 1978 to 82, sales declined 55%. Now, that was also mortgage rates back then were double digits, and the economy faced two recessions. So when you look at our 52% decline with very low interest rates, it's probably worse than the 78 to 82 downturn. Now, that's in terms of sales. If we look at downturn in terms of price, this has been no ordinary price decline. This has been a bubble. And when we're talking about bubbles, we like to not just focus on the particular asset class of real estate, but we like to look at other bubbles. For example, the Dow Jones back in 1929 was a bubble, crude oil in the 80s, the Nikkei 225 in the 90s, and of course the NASDAQ in 2000. And if we look at these other four massive bubbles of assets, we see that even 10 years after the peak, that prices have languished well below the prior top, suggesting that it's going to take a long time for prices to return, particularly in some of the harder hit areas such as Arizona, California, Florida, and Nevada. But if we take the peak of the housing index, which was right about 2006, if we say that is the peak, and then the decline, and we map that and we compare it to other bubbles, we don't see any great improvement in housing prices anytime soon. We don't have anything in the U.S. of this scale nationally, but I thought it would be useful to take a look at some regional declines of this magnitude. For example, home prices plunged about 25% over 4.5 years in Houston after oil prices collapsed in the 1980s. It took about 15 years for housing prices in Houston to get back to the previous peak. Similarly, prices suffered a 22% decline over 6.5 years in Los Angeles in the 90s. It took 10 years for the houses to recover to their previous peak. Some people may remember the decline in house prices in the Boston area in the 90s following the savings and loan debacle. Their prices retreated about 12% over 3.5 years, and this gradual recovery took about 5.5 years to close the gap. Prices and during this cycle in California tumbled about 60%. And in Florida, they've been chopped in half in almost 3.5 years. And so nationally, prices have dropped about 13% in just under 3 years. If we assume that prices appreciate at about 2% per year, which is roughly the long-term rate of inflation, it will take about 7 years to get back to the previous peak. Now, in previous cycles, prices did not decline nominally in the past 40 years. They did decline in real terms. In 1979 to 82, there was a 3-year decline of 17.5%, and there was another 3-year decline in the early 90s. So far this cycle, as I mentioned, we've seen a 3-year decline of nearly 19% in real prices. So anyway, when we look at the nominal rate of appreciation, which we think will be somewhere around 2%, it's going to take a good 6 to 7 years before prices recover back to their previous peak. If we look at appreciation rate of 4%, If we're wrong and prices actually double 4% per year, we would be looking at about 3.5 years for them to recover. I think that 2% is a much more realistic number to use. Now for our last point, all these predictions and estimations of supply and demand and recovery, in my opinion, depend really on one major thing, and that is the labor market. If we look at the declines in housing prices previously in the United States, and we compare that to what was going on in the labor market, some very important trends begin to emerge. If we look at 71, 75, 82, and 92, 93 are other time periods where we had recessions and housing prices and unemployment fell, that what's interesting about this cycle is we're not sure that unemployment has even peaked yet, but once unemployment has peaked, then when the employment rate starts to reverse, then I think we'll start to see some movement in the housing industry. If we look back historically, real home prices have not started to move up until the unemployment rate approached the full employment rate. Now, as we know, 100% employment is not A, a realistic goal, or B, the best for the economy, that we think that the full employment rate is probably a little bit higher now, somewhere between 6 and 7%. If we look back historically, home prices have not started to move up until we've approached that. So until unemployment reaches around 8%, we would not look for any significant increase in home prices. So that's our summary on what's going on in the housing market. When we come back, we'll take a look at our outlook for the stock market. For All Things Money, I'm David Blain.